Assalamu alaikum friends. Welcome to today's lecture, which is lecture 68, additional performance measure, which again comes under analysis and interpretation. So let's start. APMs. What are some examples of APMs? A type of additional performance measure. These are some additional, okay, which are additional to your IFRS standard. Okay. So one is EBIT, that is your earnings before interest and tax. Then we have EBITDA, earnings before interest, tax, depreciation, and amortization, and we have net financial debt, gross debt less cash and cash equivalent, and the other financial asset. So make sure that you know this, okay, and you know the what it includes. For example, if it is earnings before interest and tax, EBITDA, what it includes, what it excludes, you have to know this, okay. These are some types of additional performance measures, some examples, because you can be asked from this areas in your exam, okay. And then we have free cash flow, cash flow from operating activity less capital expenditure. If you see there is one L that is missing in capital, it's the typing mistake, okay. So it's a capital expenditure. Okay, so this has four types of additional performance measure. It does not mean that only you will be asked these four types. You can be asked various other types. Okay, it depends. Whatever it is, they will mention it. For example, if they mention underlying profit, you must have heard this underlying profit from your revision kit. What is underlying profit? They will say what it includes, what it excludes, and all. Okay, but these four are very common and commonly asked. Okay, for example, EBITDA was asked, EBIT was asked. These are very frequently asked, and usually these questions are asked in question number 3 or 4 of your SBR. Now we need to know the benefits and drawbacks of this. Everything has a benefit, everything has a drawback. You need to know this, okay, because in your answer you need to write this. They will specifically not ask you in a straightforward manner that please talk about the benefit or talk about the drawbacks, but they will say what is the usefulness of this APM for the stakeholders, or what is the drawback. So in this way you have to direct your benefit or drawbacks towards one particular group of stakeholders or shareholders or investors, whatever it is. The question will specify, but these are some general benefits and drawbacks. You need to know it, okay. Number one, benefit. It helps users to evaluate an entity through the eyes of the management. Why eyes of the management? No one has the information of the company the way managers do. Managers know the most information of the company, okay, more than any other stakeholders in a company. Managers are the one, especially the high level managers, they know in and out of the company, okay. So this additional performance measure, when you do it, okay, any user, for example, it could be investor, shareholder, it will help them to evaluate the entity, the company, through the eyes of the management, okay, how the management thinks. Second, it enables comparisons between entities in the same sector or industry. If other entities are also doing this additional performance measure, it will help you also to compare with them, okay. Then striping out elements that are not relevant to the current and the future year operating performance, okay. So it removes those out if it's not relevant for the current and the future operating performance. Because additional performance measure, remember, there is no specific standard which guides it. No specific IFRS. You don't follow IFRS here. No standard. It is very open-ended, very flexible. Every entity can use it in a different way. That's why you can stripe out which is not relevant for the current and the future easily from this, unlike IFRS and all. So because of that, now we are moving towards the drawback. The drawback is because they might calculate it in a different way, okay, because every entity calculates, I told you, it's open-ended, very flexible. Anyone can do it in any way. You cannot say this is correct or that is wrong. So because of this, they calculate it in a different way year on year. So comparison from year to year becomes very difficult. Maybe this year you have done it in a different way, next year you have calculated the free cash flow in a different manner, so comparison becomes hard. Second, two entities calculate the same additional performance measure, it's the same, for example, free cash flow, but in a different way, then the entities also you cannot compare. Third, entities, what do? They often provide very little information on how that additional performance measure they have calculated it. They just show it that this is the amount or this is the measure. That's it. They don't show the figures, how they have got that figure. Okay, how they have reconciled this figure with the figures that are in the financial statements. They don't do that. Fourth, because additional performance measures, see, they are selected. Okay, an entity selects, okay, out of all what they want to present as additional performance measure. Why do they do that? To show that their company is in a favorable position. They try to show a company overly optimistic. That means they overstate the company's performance. Then too much information can be confusing to the users. Too much, because users will not understand what is important, what is relevant, what is not relevant, because they anyway have the information from IFRS, from through the cash flow statement, statement of financial position, statement of profit and loss, and other comprehensive income. Now these are some additional, so it becomes very confusing, too much. Then the last drawback is some users, some preparers of financial statements, what do? They give so much of importance to this additional performance measure, okay, which can mislead the users, which can mislead the investors, whoever is relying on that financial statements. Because what do they believe? Because see, users does not know whether this is prepared by an IFRS standard or it is a requirement of IFRS standard. They don't know. Okay, they believe that it's a requirement of IFRS standard, so they it becomes more credible in the eyes of the users. While the truth is, it's not, because APM is something which you have prepared in your own way. No specific standard is guiding it. You understanding? No specific format. Unlike IFRS, we know. Okay, this is the way. If cost is calculated, this is the cost. This is what we include. This is what we exclude. But APM is not like that. Because of this, if anyone gives it so much of importance, the preparers, users think it's an IFRS requirement, and hence they, what do I say, underestimate or overestimate the performance of the company. Okay, so these are some drawbacks. You should know this, keep in mind, and while writing your answers. And definitely there's a demo also which I'll be showing you shortly, on how to answer a question on this topic, APM, which has also come in your past papers also very recently, so you should be able to know it. Okay, so now let's start with a question with some examples, two examples and then a question of based on your APMs. Underlying profit. So Bug is a RUG group who is a public limited entity, and he reports underlying profit before tax. Okay. In his annual financial statements, and in the disclosure note, they have reconciled this underlying profit before tax to profit before tax. And now they have given an extract of financial statements. Okay. So in order to provide shareholders with additional insight into the underlying performance of the business, items recognized in reported profit or loss before tax, which due to their size and nature do not reflect the group's underlying profit, are excluded from the group's underlying results. Okay, so they have excluded some from the underlying profit. Okay, so let's see what are the items that they have presented. Underlying profit before tax, profit on property disposal, they have added fair value on investment property, impairment, transaction costs, IT write-off, defined benefit expenses they have deducted. And now the profit before tax is 571. So what does this say? Some stakeholders, they argue that disclosure of additional performance measure, that is APM, okay, it makes it easier for the stakeholders to assess the, okay, so the main word is it makes it easier for the stakeholders to assess the future profit and cash flows. Okay, if you give more information, additional information, performance information, stakeholders can now assess the future profits and cash flow better. Okay, because now they have additional performance measure. But there are drawbacks to this APMs. Okay, this is just an example. Okay, this is not a question. Okay, but this can also mean that because you are giving additional performance measure, Okay, and remember, additional performance measure, as I've mentioned earlier, they are not prepared under IFRS. There is no specific standard that says APM should be calculated this way, this is the way it has to be disclosed. So it is up to the entity. Okay, entity does it voluntarily. It's up to the entity. Every entity will present APMs in a different way. That's the reason that when entities want to disclose additional performance measure, they often do it to show their company in a favorable position. Okay, so that's a disadvantage for the stakeholders who are assessing that company. Okay, they want to uh, present it in a more favorable light than it would have been if you have prepared it under IFRS standard. If you have just given performance measure based on IFRS standard, because underlying profit is something which is not under IFRS standard. IFRS standard does not specify or define what is an underlying profit. Okay, it comes under adjusted additional performance measure, which obviously you want to show it in a favorable light. So you're misleading the investors here, trying to show that you are in a better position. That's a disadvantage. So there is an advantage also of APM, there's a disadvantage also. This is just an illustration. Now the second example is of a free cash flow. This one was of underlying profit. Okay, from your textbook only I've taken it. Okay, it's from nowhere else. It's from your Kaplan textbook only, solely from your Kaplan textbook. Okay, and now free cash flow, this is another item that you can present it under additional performance measure. Okay, so I'm not going to read blah 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 blah, what does it mean, what does free cash flow, all those things is not needed. Okay, directly I will just go to the number. Okay, so if you see here, okay, if you see from 2000 to 2001, there has been a decline in cash generated from operation. Okay, but free cash flow on the other hand, it increased from 275 to 315. Okay, so now how are you going to analyze this company based on it? What are you going to see? Just see here what they have written. The last few paragraph matters a lot. Okay, so if you see, even though there's a lower cash in 2001, cash generated from operation, okay, the free cash flow is higher in that year. That means now you will be having more amount to repay your debt and as well as pay dividends to investors. Okay, but this, okay, this increases the strategic capital expenditure. If you see, uh, we have 93 here, we don't have here, it increased by 93 million. Okay, another disadvantage is that no definition. Okay, no definition is provided as to what this relates to. That means what is the strategic capital all about? There is no definition. How do you arrive to that figure? All these things investors need to know. Okay, they just don't look at your figure and then decide, oh, profit is increasing, so let's invest. No, they have to see the source. From what is the source that you're taking this figure from? For example, if I say tax paid, they will verify. They will verify. Don't think they will just look at the figure and then they're full sitting over there. No, they need to know each and every item, how it is derived. It has to be reasonable for them. It should sound reasonable to them before they make any investment decisions. So for strategic capital expenditure, there is no definition, not even in IFRS also. So it makes it very difficult for the investors to assess this performance based on this. Okay, and because you cannot even compare it also, like for like. Okay, and another thing is, as we have mentioned before, on the underlying profit, same for free cash flow. It's an attempt made intentionally by you to show your company in a favorable position. That's why you see cash generated from operation declined, but free cash flow increased. So it has, so a reasonable person will ask this, why is it so? How? Okay. So this, I don't worry about so much about these things. Okay, these are just examples. Okay, the real question will be different. So exam focus. Okay, what do you have to do? It's important that you refer to the real set of financial statements. Okay, see, having a just additional performance measure is not a substitute for having cash flow statement, income statement, statement of financial position. The information that you collect from these three statements is important. It's core. You need it. It's a must by IFRS standards also. Additional performance measure, if you want, you can give. If you don't want, don't give. But most of the listed entities now they disclose it voluntarily. They disclose this additional performance measure. It's appreciable. It's appreciated that if you do that. But it's not a subsidy. You cannot say just because I have given additional performance measure, I will not give my cash flow statement. I will not give my statement of financial position. I will not disclose. You cannot do that. Okay. Additional performance measure is something extra to what you are doing. Okay. So when you are assessing the company, you have to go to the financial statement number one, and also see the APMs whether they are useful, they're confusing, or they are even misleading, because they can be useful sometimes, they can be confusing, and they can be misleading also sometimes. You have to see this in your exam. Okay. Definitely when we go through the revision kit questions, I have not solved a question on adjusted present, sorry, additional performance measure, but I will be doing it soon. So when we go to the revision kit questions, we'll be solving this type of questions, how to do this type of questions, because this is something very unique to your normal questions which we used to do, where we used to solve an accounting treatment based on a specific IFRS. This is not like that. There is no IFRS here. This is like an open-ended question. You can write and write and write. Okay. So now, the last question for the day, and with this we will conclude additional performance measure. Okay. It has come recently, so this is very important. You cannot forget about this. You have to include it in your preparation when you're studying for SBR. Now, test understanding 5. Okay, so here also they have taken additional performance measure, the underlying profit. They have included this. Okay, now they have disclosed this certain things. If you have seen earlier, they have gotten a loss before tax, and then they have done these adjustments: finance cost, depreciation, amortization, impairment of brand, foreign exchange gains, everything, and then they have got an underlying profit. So it's very curious. Okay, one might ask how suddenly it became from loss to profit. Okay, so now they also have presents comparable information for the prior period. Now, what are you required to do? Discuss why this APM may not be useful to Hutton stakeholders. This is a very exact type of question you can expect in your SBR also. Here they didn't give you marks because this is from your test understanding, but in your exam you will be given marks. So based on your marks, you will know how much to write. Okay. So if you see, this type of question is very open-ended question, not like earlier questions where you know, okay, this is talking about intangible assets, so let me use IS 38. This is talking about inventory, so let me talk about IS 2. This is talking about deferred tax, let me talk about IS 12. It's not like that. This type of question does not have a specific area. Okay, you can use your knowledge from various other studies also, your performance measurement, your APM if you are doing, your SBL knowledge, so many things you can use here. Okay, but when you're writing this, even though it's open-ended, you have to know how to be specific to an open-ended question also. Otherwise you will lose marks and you will lose the track, and you might write too much where you should not write, and you might miss out the important points that you have to include. Okay, so let me show you today how to include the how to write an answer for an open-ended question like this. Okay, why this? Well, because it's discuss. So you can discuss in any way, you can write any points. Not every person will write the same points. Does not matter, the way you write matters a lot. Okay, so discuss why this APM may not be useful. APM is this, all this adjustments. Basically you have to talk about all this adjustments, whether you think is reasonable or not, to get from loss before tax to underlying profit. Okay, so let's go to the answer. Okay, if you see the answer, just see the length of the answer. Okay, it's big, right? It looks big. So when you go through the answer, it looks very big. What you are supposed to do is supposed to break down this big piece of information into small pieces. Okay, because this answer, when someone writes an answer, they don't think of, okay, I'm going to write this much. They don't think of the length. They decide how many points I'm going to write in how many paragraphs, and based on the marks. Okay, so if you see every point as a space in between it, that means they're talking about different point in each paragraph. Okay, and it's very easy to know in each paragraph what you're talking about, because I told you in my earlier videos also, your first word, okay, what you're talking about in that paragraph should be in your first line. Okay, the first few words should describe it what you're writing. For example, the first paragraph, let me only see the first paragraph, which is only this one. We'll go by paragraph, we'll deal with this. Okay, so if you see, it talks about depreciation, it talks about amortization. Do I have to think and search in that paragraph what I'm talking about in that paragraph? No, it's clearly understood. It talks about depreciation and amortization only. Okay, so in your exam also you have to break down like this. Okay, and best idea to do is follow this order. Okay, they have not included finance costs, it's okay, there's a reason for it, we'll go through that later. But if you see this order, there is an order, so that means I'm going to talk about this, then then this, it's an order. So you know, at least 5 paragraphs, 4 to 5 paragraphs I will get from this only. Okay, so now your paragraph is decided. See, don't worry too much about how many lines I have to write. Don't stick to, okay, I have to write 5 lines, okay, I have to write 2 lines, I have to write 10 lines. It does not matter. The lines does not matter. The points only matter. Okay, and don't worry about the length too much. That for 10 marks, how many lines, how many pages I have to write. Now you're typing everything. Now it's on a CB platform. So this should be very easy for you. Earlier we had to cut everything again. Right now you can just erase everything and write again. Rewrite. Okay, so first point, see, depreciation and amortization you can include in one paragraph. Why? Because the nature is same. Both are same. Okay, the only difference is depreciation is for tangible and amortization is for intangible asset. That's it. But the nature is same. So wherever the nature is same of two things, you can include it in one paragraph, like how they have done here, depreciation and amortization. They're judgmental. The keyword here, okay, let me highlight it for you so that you know. Okay, please, while you're preparing and while you're watching those videos, I would recommend you to have a notebook of your own and write these points. These are very key points. No one will tell you. You will not get these points anywhere. And specifically, it's more recommended if you are doing a self-study. If you're not studying under any experienced tutor. Okay, it's must. You might think that, okay, I will remember this. No, you will not remember. How much you will remember? You have so much of things to going on. You will not. So keep a note. Okay, that I'm studying. For example, you can make a heading at additional performance measure under this test your understanding 5, and these are the points. Later, whenever you feel like, you can go and do it again or refer it back. But just make a note. Okay, whether you understand or not, it's a different thing, because you can always come back again and always see whether you are understood it or not. But writing thing, you have to write it. As soon as you see something, pause the video and write, make a note. Don't wait till I finish the video, then I will make my notes. Or don't think that, okay, let me finish the whole textbook, I will just see the videos later, I will make, someday I will make notes. It does not have, it does not work like that. You are wasting so much of time. Okay, because you have to be time efficient also. As soon as you see, you write. Okay, so while you are hearing also, you can make notes. Okay, or you can pause and you can make notes, or at the end of the video, if you feel like, you can summarize everything and write a note. That's also okay. So the main thing is, they are judgmental. Okay, and also the second nature is their non-cash expenses. Two nature. Okay, so what have they done? They have excluded this from the underlying profit. Excluded this from the underlying profit. Ignores the fact that entities non-current assets will need to be replaced or enhanced in the future. They have excluded this. Why? You see here, they have added it back. If you see, it's added. With this loss, they have added depreciation and amortization. What happens usually? You deduct this two and then you get the loss before tax, right? Loss or profit. So now you are adding it back. So adding it back means you are giving them a sign, or you are ignoring the fact that an asset, non-current asset, needs replacement or enhancement in the future, which is not true, right? You do need replacement and enhancement. That means this too has to be there in your expenses. But they have excluded it from the underlying profit. I mean, to arrive to the underlying profit from loss before tax, you see, it has been added. That means it is excluded from the underlying profit. That's why your loss became profit, because you are excluding the expenses. You are adding it back to the loss. The same way how you do your cash flow statement. from profit before tax or operating profit, you change to the cash flow. From operating, you add back the two things, right? Because you are doing an adjustment, you are changing the profit to cash. Here also same way, because they feel it is judgmental and it's non-cash expense, so exclude it. But is it true? To get underlying profit, you have to exclude it. It's something to debate on, but that's not our focus. Our focus is you have excluded it. Okay, so it ignores the fact that an asset needs replacement or enhancement in the future. So first point, you have talked about depreciation and amortization, two things. Second thing, second paragraph, impairment of a brand. Okay, you see here, it's an impairment of a brand only. Same words only are picking up from there. What's so much to think about? Impairment of brand 7, this also they have excluded it. Why? How do I know they have excluded it? Because they have added back to the loss. It's a positive figure 7. This also they have excluded it. Impairment of a brand. So impairment of a brand, what does this suggest? Forget about excluding or adding, or before that, what does impairment of a brand suggest to you? That means your brand is going down, it's becoming weak. That's why it's impairing, right? It's not a good sign. That means if you see in the future, it is weaker than expected. That means management, it also indicates. See, you have to do analyzing. So you have to talk about what it means, what each means. Okay, so this means management has overpaid for the brand. Okay, so because they have overpaid for the brand, what are they doing now? They are adding back this expense when they are calculating underlying profit. Very clearly you can see from the calculation, but you have to write it down also. Here, this is the place where most students struggle to write from the calculation to the word how to write. Okay, so we all know they're adding back the expenses, but why? What is the reason? The reason is because they feel it's overpaid for the brand, so add back the expense. Okay, what happens when you add back the expense? When you add back the expense, okay, it hides your impairment. Okay, because your actual brand is impairing, right? If you add back, it shows like that. No, because you're having a higher profit, your business is doing good, but that's not true. You're diminishing the significance. It's a significant fact that brand is impairing. You have to show it, but you're adding it back and increasing your underlying profit. You understanding? So you are diminishing the significance when assessing the past decision of the management. See, if you add back the impairment of the brand, you cannot, looking at that underlying profit, you cannot judge, you cannot know what is the past decision of the management, because that impairment of brand is not shown there now. But if you are showing, if you're not adding it back and showing it as an impairment of brand, okay, then they will know, okay, management has overpaid for the brand. Someone looks the figure and they will know, but now you're not. And also this will have an impact when you're predicting their future performance. How do you predict future performance? Based on some key facts, like when your brand is impairing, it shows in your future the brand is going to be weaker than expected, so investors will not invest. So this is the second point, impairment of a brand. Now you see things become easier when you know, break down big information, big chunk of information into small pieces. Okay, just think it, link this. Okay, this is not something to do with the study, but just think, apply this into your real life also. When you eat a food meal, how do you eat the meal? You don't eat the big chunk of meal all together, you take small bites and then you eat, right? So that it gets digested. Same way, when you write answers also, you cannot write everything. You cannot think like this. Okay, don't think of too much of things. Know how I'm going to break it down, how many paragraphs, how many, the way I'm going to write it. Okay, the starting point, the ending thing, how I'm going to end it. Okay, so now the third point, foreign exchange differences. First word only, without wasting time. Immediately, first word says which point you are going to write about. Foreign exchange differences is the fourth point. On monetary, this also they have excluded it. They have added back to the loss means excluding it. Okay, so this they have excluded it. Before talking about excluding, you have to talk some nature about it. Okay, the nature, for example, depreciation and amortization we talked, that is judgmental non-cash expense. Same way for foreign exchange difference also, what is it? It can be volatile, right? Is it correct or wrong? It is volatile, right? It keeps changing. Exchange differences is there. Every time it keeps changing, and the exchange differences are not same. Every time the exchange rate keeps going up and down for the monetary items I'm talking about. So because of this differences, they think, okay, that it distorts the entity's performance because it keeps changing, and if you keep this, okay, then it will have an impact. What are the monetary items? Like receivables and payables. Okay, if now you can break down that monetary items also further to describe more specific. You see, it's an open-ended question. The question was, discuss why just an additional performance measure will not be useful. So this additional performance measure is made up of many information like depreciation, amortization, impairment of debt, foreign exchange differences, fair value gain on financial assets. Each of this you're breaking down and then you're explaining. Because additional performance measure as it is, you cannot explain like that. It's not that one thing only you explain and that's it. No. If you see the marks, it will be around 10, 12 marks. Or maybe let's say 7, 8 to 10 marks. This question will be. So break it down more. Wherever you can see that I can break down this further, break it. Okay, like for foreign exchange differences on monetary items, this monetary items also you can break it down like receivables and payables. These are examples. You are going to receive money or you are going to pay money from that. That is the meaning of monetary items. So like receivables and payables, your inventories are not your monetary items. Your non-current assets are not your monetary items. Okay, they are non-monetary items. So receivables and payables. Another nature is they are short term. They are short term. Okay, and so their gain and losses will be realized in the near future. That means very shortly you will realize their gain and losses. Okay, so it would seem that Hunter always refer it back to the company. Don't keep your answers in general sentences. At least once in your answer you have to mention about that company. It shows you are linking to the company. So it would seem that Hunter will be receiving less units of his functional currency or paying more. So you're receiving less or you're paying more in this case. Why? How do you know? Because it's a loss. Foreign exchange loss. Foreign exchange loss means you are receiving less, paying more. One of these two things can be there because they told on monetary items. They didn't say specifically for receivable or payable. That's why you don't know. But at least you know you're receiving less or you're paying more than which is originally expected when the overseas transactions are settled. And it seems odd. After explaining all the things, then you are finally saying it seems odd to exclude this losses from the underlying profit. So that means this is quite shocking that after knowing it, why they have excluded it from the underlying profit. Because this loss has to be there. Okay? Because it is something that you are going to realize it in the near future only. So it's very odd. It's odd means it's not reasonable to exclude this from the underlying profit, but they have done it. That's why they have added it back. Now the fourth item, the last item. Fair value gain on financial assets. Okay, whenever someone sees this word financial assets, financial liabilities, equity instruments, they always get scared. They're like, oh shit, IFRS 9. Because I'm sure, okay, I can bet you that no one likes IFRS 9, to be honest. A student getting question on IFRS 9, they will be panicking half of the time. Because they always feel that this is very tough standard. It's not like that, okay? From that standard, maybe I think not even one person you have to use in your answer. Like answer questions like this where they're specifically asking you an additional performance measure. If it was specifically for IFRS 9 for financial assets, how they are measured, how they are counted, yes, then I can understand. But this type of question, you don't have to worry too much because you don't have to use the knowledge of financial assets, that is IFRS 9 here. It's not required. But you have to talk about the nature of it. Financial assets, some nature from IFRS 9 you have to know. Without that, you cannot write this answer, even though the question is for APM. Okay, because APM is made up of many different elements. So this, if you see gain, they have deducted this gain. Okay, they have deducted this gain from this one. That means this also they have what? Kind of excluded only. Why? Because to arrive this loss, they must have added this gain. Because gain you add and then loss expenses. These all are expenses you deduct, right? Expenses they have added, gain they have deducted. That means this also they have uh, eliminated it, right? They have excluded it. So now we are going to talk about, and this is measured at fair value through profit and loss. Okay, is it so? Let's see here. What gains on? Yes, it says this one. Fair value through profit and loss. Okay, so they will not write the whole thing. They will just write, if it is profit and loss, they will write FVPL. Otherwise, they will write FVOCI. So this is the word. This is how you know whether it is through other comprehensive income or profit and loss. Okay. So this is through profit and loss. Okay, and they are volatile. Volatile means it keeps changing very rapidly. No, okay, it's not very stable. Is it? Is it? It's correct, right? Financial assets, fair value will definitely change. It's volatile. Okay. So because if something is volatile, remember it becomes more difficult to compare this with the prior year or with other competitors and all. If something is stable, you can still compare. But there is a nature of financial assets, same like your receivables and payables. This is also likely to be sold in the short term. Financial assets like your debtors, your cash, okay, any financial instruments you have. So these are likely to be sold in the short term. And because of that, any gain or losses also will be realized very soon. Okay. They are also unlikely to be one-off items. It's not one-off items, unlikely. Entities that trade material quantities of financial assets. Okay, there are some entities. Okay, see, some entities are specifically into financial assets only. They trade on this. So when for those entities, they do material quantities of financial assets. They do trading in material quantities. Will probably enter into a similar transactions on a regular basis. So for this entity, it's normal. It's not one-off item. Okay. So based on this, they have excluded that also. So it does not look reasonable. So if you see all this thing which they have excluded it, whether it's depreciation, amortization, impairment, foreign exchange gains, all these things does not look reasonable. Okay. So now you should know after you write how to summarize everything, the overall summary. You have to know it. How do you do that? It's overall, just say overall. You know, first one is also not reasonable, second one also is not reasonable, third one is not reasonable, fourth one is not reasonable. What does it suggest? It's very easy. That they are trying to disguise a weak performance. One word. Always try to bring everything in one sentence or one word. If you are able to do this, bravo. That means you're on the right track. You can answer any ACCA paper. Not only this. Because in ACCA, this is the skill that you need to know. Any students who have passed ACCA, go and ask them. They know how to summarize everything. And when they have to write in detail also, they know how to break down that summary and then write into details. You should be able to do both the ways. You should be able to write it in details, and after you write everything in details, summarize everything at the end. This has to be there. This skill has to be there in any paper that you apply, specifically in professional level papers, because there you have to write a lot. There is no MCQs to save you. You cannot rescue through MCQs, unlike applied skills papers and all. So it's very important. Okay. And this also comes through practice. You need to read answers and see how they write, break down, then summarize, and you also have to write it. Okay. Without you writing it, you will not be able to understand where you stand on that, you know. So disguise a weak performance, because you see it was a loss before and suddenly it has changed into a profit. -8 becomes 19. So doing all these adjustments, excluding all these, shows that they are trying to hide a weak performance. Okay. Because this turned a loss before tax into a profit. And this could be misleading. You have to write these words, okay? Misleading, okay? Because you are doing an analysis, okay? You are analyzing the company, so they are misleading. If APM is presented with prominence, that means you are paying more attention to the APM than you are clearly misleading it. However, to Hutton's credit, okay? Hutton's credit means in his case, what do? There is an advantage here. They disclose the calculation also behind this one. What is the calculation? See, rather than just saying that the underlying profit is 19, earlier the loss was 18, they have disclosed it like this. They have break down the information and showed what are the adjustments they did. So this is a good thing. You will be able to correct it there itself, and you will be able to know what is the uh, problem, and you can reconcile this also. So how they have reconciled it to the figures in the financial statement, they have shown it, they have disclosed it. Amortization, depreciation, all these are financial statements figure, they have reconciled this. Okay, so because of this, this will enable them to draw. Enable them means the stakeholders. Always talk from the point of the stakeholders. You will be asked stakeholders, shareholders, okay, who is the party, but most of the time if they don't say any party, stakeholders. Okay, so this will enable them to draw their own conclusions. Based on this, now they can, each one of them can draw their own conclusions about the adequacy and the usefulness of this, whether it's useful, whether it's confusing, whether it's misleading. Now they can decide on their own because it was disclosed. If this was not disclosed, then it will become very confusing. Then you cannot make a decision based on that. Okay, so that's it for it. Just sorry, I always you know it is additional performance measure. So that's it. And next, we'll be covering tech companies. How do you analyze tech companies? What are the differences? Because remember, tech companies is very different to your normal trading companies and all. Okay, so till then, thanks for watching and see you in the next video.